Sir, let's talk about the timing here. At the height of the war, well, it's of course still ongoing, but we're hoping for a resolution. Finance Secretary Sonny Dominguez mentioned that this would just be a temporary issue. Particularly when it comes to inflation, they've tried to reassure us that there have been wars before, there have been issues before, there've been oil price hikes before, but that this eventually did not persist. However, you have the IMF saying that it is persistent, peaking after 1 year and lasting up to 18 months. Tell us, to which side are you more inclined to say that this is a long-term effect?
Well, on the constraints of the logistic, no, I think this will go through all the way the year 2022 and could spill over 2023. The lack of cargo vessel. Although the freight freight fees is very high, exporters now have to pay about four to five times the freight that they used to pay. So that has been hurting. On the other side, the shipping companies has ordered new vessels, no? But what I heard is they will be online only 2023. So the congestion is still there, not only on the shipping vessel, but also on the port operation. China again has been hit with some surges on COVID-19. And with the zero COVID policy, they're closing down some ports. And that has affected the logistic issue and will drive costs higher. The war also in Russia and Ukraine, the shipping companies has to route the vessel to avoid this area of conflict, and it takes longer to make shipments. And again, that adds on to the the limited supply of shipping vessels. So we're not going to see that immediate solution for within this year. And I do agree that from the point of Department of Finance, that this is a temporary issue. I look back on the chart of the fuel on oil in the past 10 years, no, and I can see that through the decade, I think there are about 6 or 7 years wherein the oil price has gone down. It's only this couple of years wherein because of geopolitical issue that the oil price spiked up. So with the economy not really in full force, no, not only for us, but also for North America and Europe, the demand for oil is not that big. This is a temporary issue, and I go along with what the Department of Finance said. No, probably this will be tamed.
Okay, sir. Do the volumes not compensate for this issue in terms of inflation? I mean, you have the rest of the world opening up. You did mention China, possibly not yet there in terms of also like demand. It's softening. But has the impact of the reopening of the global economy not compensated in terms of volumes for our exports? And in addition to that, also the weaker peso, has this not benefited our export market?
Well, I think the exporters are taking advantage. They can ship their goods out. Earlier, I mentioned about the lack of cargo spaces, and that's quite a big concern for those exporting perishable products like mango or agri products. So we're optimistic that this can be resolved. But what's happening now in North America, in Europe, is that they're more concerned about energy costs. The energy has spiked up, no, because of the fact that I think there's a limited gas supply coming from Russia, and it has sort of tamed down the economic recovery. For us, the projection that was made earlier, I heard you said about 6.5%. I think if things settle down, that would be achievable, even with the new government, because there are so many things that have been set that is favorable to our country to attract foreign investment. The tax reform, the bills that have been passed to attract investment. So we're quite hopeful, a guarded optimism, wherein the inflation should not go too high, interest rates is maintained, and our wages is satisfactory to the labor sector. So we can work together on a partnership going to with the new government.